What if financial freedom didn't require thousands of dollars? What if your entire investment journey could begin with just $100?
Many people think investing is complicated or only for the wealthy. The truth is, building wealth is often about three simple things: starting early, staying consistent, and investing in the right assets. Today, I'll show you a simple investing blueprint that anyone can follow, even if you're starting with just $100.
Imagine two investors, both starting with $100. One begins at age 20, the other at 30. Who ends up with more?
The investor who started at 20. Not because he is smarter, not because he earns more money. He simply gave his investment more time to grow. In both cases, this is called compound growth. Your money earns returns. Then those returns earn even more returns. Over time, the growth can become extraordinary.
Waiting for the perfect time is a mistake. The best investment advantage you have is time. Start compounding early.
One of the biggest myths is that you need a lot of money. You don't. You can begin with $100. The goal isn't to get wealthy overnight. The goal is to develop the habit of investing. Small amounts invested consistently become significant. Now, let's talk about where to invest. Many beginners are tempted to chase hot stocks or the latest investing trend. The problem is that very few people consistently pick winning stocks over long periods. That's why ETFs are such a powerful tool. ETF stands for Exchange Trade Fund. An ETF is a collection of many companies bundled together, giving you diversification, lower risk, and simple long-term growth.
Here's the SmartSociety's blueprint. Whether you're a millennial, Gen Y, Gen Z, or even Gen X. Step 1. Open a brokerage account. Choose a reputable brokerage that allows low-cost investing. For the SmartSociety, Vanguard is our go-to for ETF investing. It's a simple process of opening an account and using the search bar to explore the many ETFs that are available to invest in. I'll break down exactly how to research the different ETFs in the next video, focusing on its category, SECI yield, market price, and most importantly, its risk ratings. Step 2. When you're ready, invest your first $100. Don't wait until you have more money. Start now. Step 3. Choose a broad market ETF. Focus on diversified investments rather than trying to find the next big stock. Step 4. Automate contributions. Invest every month. Even $25 per week can make a meaningful difference over time. Step 5. Stay consistent. Markets rise and fall. Don't let headlines determine your strategy. Every investor faces market downturns. The news will tell you the market is crashing. Friends will tell you investing is too risky. Social media will encourage you to chase the latest trend. Step 6. Increase investments as income grows. When you receive raises, bonuses, or additional income, increase your investments whenever possible. The key here is stay consistent.
Successful investors stay focused. They understand that wealth is built through patience, discipline, and consistency. The goal is to become financially free over time. If you found this helpful, subscribe to the SmartSociety. Join us as we build a community of young minds. We'll see you in the next video.